Welcome back to the Deep Dive. I'm sure you've listened to at least a few of your favorite playlists on Spotify this week, right?
Oh, absolutely. Who hasn't?
Well, today we're going behind the music, taking a deep dive into Spotify's 2023 annual report.
Buckle up. It's a fascinating read.
Definitely. And to help us unpack it all, we have you, a seasoned expert in all things Spotify.
Happy to be here.
So where do we even begin with something like this? What were your first impressions?
Well, the sheer scale of their operation is pretty impressive. I mean, they're in over 180 markets with almost 500 million monthly active users.
Wow, that's massive. Almost 500 million people. But let's break it down a bit.
Okay, that's good.
We know Spotify has those free and paid tiers, premium and ad-supported, as they call them in the report. What's the story there?
Well, premium is definitely their cash cow. They brought in a whopping 11.7 billion in revenue last year.
Wow, that's a lot of subscriptions.
Yeah, and they're not just sitting back, they're constantly innovating, adding things like audiobooks, even lossless audio.
Lossless audio, huh? Is that really something the average listener cares about?
It's a gamble, sure, but it shows they're trying to reach a broader audience like those audiophiles who want the highest quality sound. And don't forget about their global expansion, especially in Asia, Latin America, and Africa, where streaming is just taking off.
Smart move, getting ahead of the game in those emerging markets. But what about their ad-supported segment? How does that fit into the bigger picture?
It's their way to hook users, give them a taste of the Spotify experience, hoping to eventually convert them to paid subscribers.
Right, like a free trial. It's working, too. They pulled in $1.5 billion in revenue last year from ad-supported.
It's all about volume. Cast a wide net and reel those conversions in. But of course, it's not without its challenges. Not everyone loves ads.
Definitely not. And the report does acknowledge those challenges.
Privacy regulations, like Apple's Act tracking transparency, make targeted advertising more difficult.
That makes sense. And then there's the whole debate about fair compensation for artists and podcasters, especially those who rely on ad revenue.
Exactly. It's a tough balancing act, keeping both advertisers and creators happy while making sure users aren't overwhelmed with irrelevant ads.
So how is Spotify navigating this tricky situation?
They're really leaning into their Spotify Audience Network, or SPAN as they call it.
Span.
Right. It's their platform for connecting advertisers with listeners across this huge network of podcasts. They're even creating exclusive podcast content.
Ah, so they're trying to become the Netflix of podcasts. That makes sense. But exclusive content must come with a hefty price tag.
It does. Speaking of costs, let's dive into those financials.
Yeah, let's get into the nitty-gritty. What jumped out at you from the report?
Well, first off, their revenue growth was impressive last year, hitting $13.2 billion, a 14% jump from the year before.
That's solid growth.
It is, but what's really striking is their investment in content. They've committed over $4.7 billion to future licensing agreements.
Wow, that's almost the GDP of some small countries.
It is. They're really betting big on keeping users engaged and coming back for more.
But what if subscriber growth slows down? Could those agreements become a financial burden?
It's a valid concern, and the report does mention the risks associated with those minimum guarantee clauses in the agreements.
Right, so they're obligated to pay a certain amount no matter what.
Exactly. If subscriber growth falters, they could be left with a big bill and shrinking margins.
Talk about high stakes. So let's break down these financials a bit further.
Yeah.
Where is all this money coming from, and where is it going?
Well, the income statement lays it all out. Their primary revenue stream, as we discussed, is premium subscriptions.
Which brought in how much again?
A cool $11.7 billion in 2023. Ad-supported brought in another $1.5 billion.
So the bulk of their revenue is coming from those premium subscriptions. But what about expenses? Where's all that money going?
The biggest expense by far is royalty payments to artists, labels, and podcasters.
Right, because someone has to pay for all that music and those podcasts.
Exactly. In 2023, those royalty payments amounted to a staggering $9.8 billion.
Wow. So even though they're pulling in billions, they're also shelling out billions.
That's the nature of the business.
What other major expenses are they dealing with?
Well, you know, all the usual suspects for a global tech company: research and development, marketing and sales, general administrative costs. But there's one interesting item in the report: their office space optimization initiative.
Office space. What's that all about? Are they building some giant Spotify headquarters?
Actually, quite the opposite. They're embracing remote work and downsizing their real estate footprint.
Makes sense in this day and age. But didn't that lead to some financial charges?
It did. There were some non-cash impairment charges on their balance sheet as they wrote down the value of those underutilized assets.
So adapting to the new world of work, even if it means a short-term hit on their balance sheet. Smart move, considering how expensive real estate is these days. But let's not get sidetracked by office space. I'm curious about their balance sheet overall. What kind of financial shape are they in?
Well, as of December 31st, 2023, their balance sheet shows total assets of $7.5 billion and total liabilities of $5.6 billion.
So more assets than debts. That's good, right?
It's a good sign. It leaves them with a healthy equity position of $1.9 billion.
Solid foundation then. But are they actually making money, or is it all just on paper? Are they generating cash from their operations?
That's where the cash flow statement comes in.
Yeah.
And the good news is, yes, they are. In 2023, their cash flow from operations was a very respectable $482 million.
Wait a minute, didn't you say earlier they had an operating loss?
Yeah.
How can they have an operating loss but still generate positive cash flow? I'm confused.
It's a good point, and it highlights an important distinction between net income and cash flow. Net income, which is what determines profit or loss, includes things like depreciation and amortization.
Those non-cash expenses we talked about.
Exactly. Those expenses reduce their reported profit, but no actual cash is going out the door.
So it's a paper loss, not an actual cash drain. Okay, I'm starting to get it. But what about those massive licensing commitments? Surely those have an impact on their cash flow, right?
Absolutely. Their investing activities, which include those capital expenditures for licensing content, used up $175 million in cash last year.
So even with positive cash flow from operations, they're still investing heavily in content for the future. It's like they're constantly feeding the beast.
It's a high-growth, high-investment strategy. And to really understand their cash-generating power, we need to look at their free cash flow.
Okay, break it down for me. What is free cash flow and why is it so important?
Free cash flow is the cash a company has left over after covering its operating expenses and capital expenditures. It's the cash that's truly free to use however they see fit, reinvesting in the business, paying down debt, buying back shares, even paying dividends.
So it's the money they have after paying the bills and investing in future growth. Sounds like a pretty important number.
It is. And in 2023, Spotify's free cash flow was a healthy $307 million.
Wow, so even after all those investments, they still have a decent chunk of change left over. That's a good sign, right?
There's a very good sign. It means they're generating more cash than they need just to maintain the status quo. It gives them options for the future.
Options are always good. Speaking of options, what about those shareholders? Are they seeing any of this cash in the form of dividends?
Well, here's a surprising fact. Spotify has never paid a cash dividend.
Never, really. That's pretty unusual for a company of their size and success. Why are they holding on to all that cash?
Their strategy, as they outline in the report, is to reinvest those earnings back into the business, fuel growth, and expand. They believe this approach will lead to bigger returns for shareholders down the road.
So they're playing the long game, even if it means frustrating some investors who are looking for more immediate returns.
It's a trade-off. Some investors prefer companies that prioritize dividends, while others are more comfortable with companies that reinvest for growth.
Makes sense. Different strokes for different folks, as they say. It's a good reminder that there's no one-size-fits-all approach to investing. But speaking of shareholder value, the report also mentions share buybacks. What's the deal with that?
Share buybacks are another way for companies to return value to their shareholders. When a company buys back its own shares, it reduces the number of shares outstanding, which can increase the value of the remaining shares.
So it's a way to bump up the stock price. How much have they spent on buybacks?
The report mentions they've repurchased a significant number of shares through December 2023, but doesn't give a specific amount.
Okay, playing it close to the vest on that one. It sounds like they're using a combo of share buybacks and reinvestment to try and create shareholder value. But are they succeeding? What's their track record when it comes to delivering returns for those investors?
Well, that's a question for another deep dive. We'd need to look at their historical stock performance, compare it to their competitors and the overall market to get the full picture.
All right, fair enough. Let's table that for now and move on to the final section of the report, their future outlook. How are they feeling about the road ahead? Optimistic, cautious, a bit of both.
It's a mix, really. They're cautiously optimistic, recognizing both the huge opportunities and the significant challenges ahead.
Okay, let's start with the good stuff. What are they most excited about?
Global expansion is a big one, especially in those emerging markets we talked about. And they see tremendous potential in the growing podcasting market where they've already established themselves as a major player.
So, looking to replicate their success in music streaming by becoming the go-to platform for podcasts as well. Makes sense. But what about the flip side? What are those challenges that are keeping them up at night?
Competition is fierce, no doubt about it. They're up against giants like Apple, Amazon, and Google, all vying for a piece of the audio streaming pie.
It's a battle of the titans.
It is, and those licensing agreements and royalty negotiations are always going to be a source of pressure. Content costs are huge for Spotify, and they could rise even further as competition for exclusive content heats up.
It's a delicate balancing act, keeping users happy with great content while keeping those costs under control. Any other dark clouds on the horizon?
Well, the regulatory landscape is constantly evolving, especially when it comes to data privacy and content moderation. Changes in regulations could impact their ability to target ads and personalize recommendations, which are key parts of their business model.
So they've got to stay nimble and adapt quickly. It's a tightrope walk for sure. So overall, do they seem confident in their ability to navigate these challenges and maintain their position as the leader in audio streaming?
Well, their success hinges on their ability to keep innovating, adapting to the changing landscape, and anticipating what listeners and creators want.
That's the key to staying ahead of the game in any industry, but especially in the fast-paced world of tech. Well, before we get too lost in the future, let's take a step back and reflect on what we've learned so far. What are some of the key takeaways from this deep dive into Spotify's 2023 annual report?
We've seen how their two business segments, premium and ad-supported, work together to drive growth and revenue.
Right, like two sides of the same coin.
Exactly. We've analyzed their financial performance, seeing their impressive revenue growth, but also those hefty content costs and operating expenses.
A lot of money coming in, but a lot going out too.
That's right. And we've looked at their plans for creating shareholder value, particularly their decision to reinvest earnings for future growth rather than paying dividends.
That long game approach.
Exactly.
It's been a whirlwind tour of their business operations, financial health, and future outlook. But I have to admit, I'm left with more questions than answers.
That's the beauty of a deep dive. It's not about finding easy answers, but sparking curiosity and prompting further exploration.
Well said. And speaking of sparking curiosity, let's dig deeper into those financials in our next segment. We'll dissect their income statement, balance sheet, and cash flow statement in more detail to really get a grasp on their profitability and financial strength. Then we'll wrap up by taking a closer look at their future outlook, exploring the potential impact of things like AI, Web3, and even the metaverse on their business.
It's going to be a fascinating journey. Stay tuned. Okay, so let's dig a little deeper into those financial statements. Remember that $13.2 billion in revenue?
Yeah, the top line, right?
Exactly. But that's just the starting point. To see how much money they're actually making, we have to look at their costs.
Right. Revenue is vanity, profit is sanity.
Exactly. So let's start with their cost of revenue.
Okay.
A huge chunk of that is those royalty payments we talked about. In 2023, that was a whopping $9.8 billion.
Almost $10 billion. No wonder those licensing negotiations are so tough.
Right. So after paying those royalties, they had a gross profit of $3.5 billion.
Okay, a decent margin, but we're not done yet, right?
Yeah. Nope. We still like to factor in their operating expenses, all those day-to-day costs of running a global business.
Right, like marketing, R&D, all that fun stuff.
Exactly. In 2023, those operating expenses totaled $3.9 billion.
So their operating expenses were actually higher than their gross profit.
That's right, which means they had an operating loss of $532 million for the year.
An operating loss. That doesn't sound so good.
Well, it's important to remember they're a high-growth company. They're making big investments that might not pay off immediately.
Right, like those future licensing agreements.
Exactly. So while the income statement is important, we also need to look at their balance sheet and cash flow statement to get the full picture of their financial health.
Okay, makes sense.
Yeah.
We already touched on their balance sheet earlier, but what exactly should we be looking for there?
It's basically a snapshot of their assets, liabilities, and equity at a specific point in time. What they own, what they owe, and what belongs to their shareholders.
Like a financial checkup.
Exactly. And their balance sheet as of December 31st, 2023, looks pretty solid. Total assets of $7.5 billion, exceeding their liabilities of $5.6 billion.
So they have more assets than debts. That's good, right?
It's a positive sign, definitely. It means they have a healthy equity position of $1.9 billion.
Okay, so their foundation seems strong, But what about their cash flow? Are they actually generating cash from their operations?
That's where the cash flow statement comes in. And the good news is, yes. In 2023, they generated $482 million in cash from their operating activities.
Wait a minute, you said they had an operating loss. How can they have an operating loss and still generate positive cash flow? I'm getting deja vu from our earlier conversation.
It's a common point of confusion. Remember, net income, which determines profit or loss, includes those non-cash expenses like depreciation and amortization.
Oh, right, those paper losses.
Exactly. So their operating loss includes those expenses, which is why their cash flow from operations can be positive even if they're not technically profitable on paper.
Accounting can be tricky, but the bottom line is they're generating cash from their core business, which is a good thing.
Absolutely. And that positive cash flow gives them the resources to keep investing in their growth.
Which brings us back to those investments in their future growth. The cash flow statement shows that too, right?
It does. Their investing activities, like those capital expenditures for content licensing, used up $175 million in cash last year.
So even with positive cash flow from operations, they're still putting a lot of money back into building their content library.
Exactly. They're playing the long game. And then there are their financing activities like issuing debt or equity. And those share buybacks we talked about, those also affect their cash flow.
Right, because those activities can either bring cash into the company or take cash out. So what was the net effect of their financing activities?
In 2023, their financing activities actually resulted in a net increase in cash of $587 million. They raised more money than they paid out.
Interesting. So they're actively raising capital, which suggests they're confident about their future growth.
It does seem that way, and if you look at their overall cash position, their cash and cash equivalents actually increased by a whopping $762 million in 2023.
Wow, that's a lot of cash on hand. That's got to be reassuring for investors. It gives them the flexibility to adapt and seize opportunities as they arise. But didn't you say there was an even more important metric, something about free cash flow?
Yes. Free cash flow is like the gold standard. It's the cash that's left over after all the essential expenses and investments. The cash they have free to use however they want.
Okay, remind me again how that's calculated.
It's basically their operating cash flow minus their capital expenditures.
So it's what they have left over after paying the bills and investing in future growth.
Got it. And what was Spotify's free cash flow in 2023?
A very respectable $307 million.
That's pretty impressive. It means they're not just staying afloat, they're generating extra cash that they can use strategically.
Precisely. It gives them a lot of options. So we've been talking a lot about these financial numbers, but what does all this mean for the average person who uses Spotify? How does their financial health translate into a better user experience?
Well, it means they can invest in more content, which means more music, podcasts, and audiobooks for you to enjoy.
More of the good stuff.
Exactly. They can also invest in better technology and innovation, improving their app, algorithms, and streaming quality.
So a smoother, more personalized listening experience.
Exactly. And their financial strength allows them to expand into new markets, making Spotify accessible to even more people around the world.
So these numbers on a spreadsheet actually translate into real benefits for users.
That's right. But as we discussed earlier, they also face some big challenges. Fierce competition, rising content costs, and an ever-changing regulatory landscape.
Right, those dark clouds on the horizon.
So as we wrap up this deep dive into their financials, here are a few key questions to think about. Can Spotify maintain its revenue growth as competition heats up? How will they manage those massive content costs? Will they have to raise prices? Maybe. And can they continue to innovate and create a user experience that keeps people coming back for more?
Those are some great questions, and the answers will determine whether Spotify sinks or swims in the years ahead.
It's a fascinating story, and their annual report gives us a glimpse into the complexities of their business and the decisions they're making.
It's a reminder that something as simple as listening to music involves a whole world of business behind the scenes.
Exactly.
Okay, well, let's shift gears now and talk about those plans for creating shareholder value. We know they're not paying dividends, but they are buying back shares. Let's dive into that and see what it means for investors.
Sounds good. It's a topic that always sparks a lot of debate.
All right, so Spotify is all in on growth, skipping those dividends and reinvesting their earnings. But those share buybacks, there's still a bit of a mystery. The report doesn't really give us much to go on.
It's true, they're keeping those cards close to their chest. We know they've been buying back shares, but the exact amount they've spent, that's still unclear.
So it's hard to say what impact those buybacks are having on shareholder value. Are they being strategic about it, or is it just a reaction to how the market is doing?
That's the big question, isn't it? Without more information, it's tough to say for sure. But you can speculate a little. Sometimes share buybacks can be a signal that the company thinks their stock is undervalued.
Right, like they're putting their money where their mouth is.
Yeah.
But couldn't that money be put to better use somewhere else? Like investing in even more content or maybe research and development?
That's a constant debate, isn't it? How best to allocate capital. Share buybacks can boost earnings per share and maybe increase the value of the remaining shares, but some people see them as a short-term tactic, maybe a way to appease investors instead of focusing on that long-term growth.
So it's a balancing act, and it's hard to say if Spotify's approach is the right one. But let's step back for a second and think bigger picture. What other things outside of Spotify's control could affect their ability to create value for shareholders?
Competition is a big one. Like we talked about before, they've got some serious rivals. Apple, Amazon, Google, all those big players could put pressure on Spotify's pricing and make it harder to attract and keep subscribers.
There's a real battle for listeners out there.
And then you have the regulatory landscape. All the concerns about data privacy and antitrust issues. New regulations could mean higher compliance costs for Spotify, maybe even restrict how they operate in certain markets.
It seems like governments are paying more attention to big tech companies these days.
They are. And Spotify is right in the spotlight. And then you can't forget about the music industry itself. It's unpredictable, tastes are always changing, new artists are breaking through, and technology can disrupt everything in a heartbeat.
It's definitely not a boring industry.
That's for sure. So Spotify can't just be smart with their money. They also need to adapt constantly and keep their finger on the pulse. They need to know what listeners want, what creators want, and stay ahead of the game.
It's all about being nimble and innovative. All right, so as we wrap up this deep dive into Spotify's 2023 annual report, here's the big question. Is Spotify a good investment?
Well, that's for you to decide. It all depends on your own goals, your risk tolerance, and how you see Spotify's future playing out.
That's fair. You've given us a lot to think about. We've explored their business model, dug into their financials, and talked about the good and the bad. Now it's up to each listener to do their own research and figure out if Spotify is a company they want to bet on.
Exactly. And remember, this is just the beginning. There's always more to learn, more to uncover. So keep exploring, keep asking questions, and keep that curiosity alive.
Couldn't have said it better myself. Thank you so much for joining us for this deep dive into the world of Spotify. It's been a fascinating journey, and we hope you've enjoyed listening as much as we've enjoyed discussing it.
The pleasure was all mine.
And for all you listeners out there, remember, this is just a starting point. There's a whole world of business out there to explore. So keep digging deep, and we'll see you next time for another exciting adventure on The Deep Dive.